Morning all, and welcome to the webinar on pensions with Mason Hayes and Curran and Harvest Financial Services. My name is Ronan Burke and I'm part of the Harvest Financial Services advisory team. And this morning I'm joined by Stephen Gillick, pensions partner in Mason Hayes and Curran, his colleague Patrick O'Connor, senior associate in Mason Hayes and Curran, and also my colleague Eugene Foley, Harvest Trustees Limited director. The idea of this webinar will be to keep it as interactive as possible. So you'll see below at the bottom of the screen to be a Q&A box for any questions you may have throughout the webinar. So please feel free to add them as we go along and we'll address them at the end. The flow of the webinar will start with Stephen discussing pensions at a high level and general issues. And then COVID-19, what does that mean for you as a trustee of your scheme? We'll then move on to Patrick, who will discuss pensions, single member investments, such as property in a pension scheme, loan notes, and other various unregulated assets. We'll then move on to Eugene, who'll discuss company pensions tax efficiencies, utilizing your tax benefits, and also planning for retirement and having cash flow when you do decide to retire. So I'll pass over to Stephen now to commence with the webinar.
Thanks, Ronan, and thanks indeed to Harvest for partnering on what I hope will be a very interesting webinar. As Ronan mentioned, I am going to discuss just some general issues from a kind of blue sky pensions perspective and what we've seen happen since COVID really kicked off in Ireland in March from a pensions perspective. Well, the Pensions Authority has been busy and they've launched, I think, made 2 announcements and also a statement through the Society of Actuaries. But the general tenet of what the Pensions Authority have sort of said during the pandemic is that they can't wave a magic wand, as it were, and tell schemes, trustees, advisors, etc., that they can't act in compliance with the Pensions Act. So they've said that the Pensions Act is there, the regulations are there, and schemes need to comply with that. Now, they have taken a view and they've said, listen, we will take into account the current circumstances. So it's interesting to see how this will play out in the next 6 months or so. What sort of areas does that flow into? Does it flow into member communications, issuing member benefit statements, investment considerations? So it will be interesting to see what circumstances the Pensions Authority take into account as the COVID-19 pandemic plays out over the next 6 months. When the pandemic kicked off, I think one of the main areas as a law firm we were engaged with was from employers who wanted to essentially cut costs and battlefield triage and cut employer contributions going to the schemes. Now, we have to flag, and indeed the Pensions Authority has flagged in their announcements, that this isn't a simple thing to do. Consideration has to be given to what's contained in the scheme's governing documentation, be it the trustee rules, a letter of exchange, and what's also in an employment contract. So what is the obligation of the employer to pay the contributions to the scheme? And what also are the considerations for trustees to bear in mind where an employer in a DC or DB scheme indeed seeks to stop payment of contributions? So that was something that we're dealing with on an ongoing basis. And happily, we are getting requests now where employers are looking to unwind that activity and start the contributions again. So that's a pleasant action to take in the midst of all the uncertainty. The TWSS was brought in, of course. This was the transition repayment brought in by the government. And this specifically stated that deductions couldn't be made. So essentially pension contributions couldn't come out of the TWSS. This was different to the UK's equivalent of the TWSS that did allow for AE contributions to come out of it. So employers were left with a situation whereby they were possibly paying an employer contribution, if they indeed continued it, on a lower salary because there'd be no deduction from the TWSS. So many schemes, many individuals may have lower contributions than they had planned going into schemes this year. So it'll be interesting to see whether or not these schemes will up the contribution rates or the individuals to take account of the drop in contributions that may happen this year and indeed next year. Trustees, once again, when this all kicked off, I mean, one of the main things we were told by the government was to avoid gathering together. So that really put a spanner in the works in terms of practical issues with pension schemes, so trustee meetings. So we were advising how trustees and how employers and how advisors could meet, and could they meet electronically. One of the first things to do here was check trust documentation, check governing documentation, service level agreements and the like, to see how meetings of trustees and advisors could be convened. The majority of modern schemes do have a flexibility in there whereby the trustees can meet electronically, but it's interesting to see that some older schemes didn't, and those schemes needed to be amended to facilitate electronic meetings. Some interesting things have come out in the last while in relation to COVID and how meetings and the new electronic world we're embracing in those meetings is panning out. More specifically, I think the biggest issue we've seen is in relation to data protection. And I think this will flow into the future, because you're seeing, indeed, it's a testament we're here today in a Zoom meeting. So you're seeing trustee groups embracing technology that they may not be overly familiar with. So there's the potential for sharing documentation beyond the intended audience, or sharing documentation in a means that may not be overly secure. For instance, WhatsApping documents, WhatsApping sensitive documentation, or sending documentation through a medium that isn't secure. So this is one area that I think trustees, advisors, and everyone involved with the pensions industry should be very concerned with, because this is something I can see lasting far longer than the effects of the pandemic, if it isn't managed during the pandemic in an effective way. As Rona mentioned, my colleague Patrick O'Connor, who's on the pensions team, will also give a presentation today. And he is next up, and he's going to discuss some interesting investment perspectives.
Thanks very much, Stephen. So I will welcome everyone to the webinar, and good morning. I will discuss today the regulated and unregulated investments. Unregulated investments, I guess, more relevant for single member schemes, and regulated investments will be of general interest. So the Pensions Authority announcement in March said that, to summarize it, said that no knee-jerk reaction should be made in terms of investment decisions. I guess this is with an eye to what happened during the credit crisis. You know, flights from equities and other asset classes, leading to missing out on the subsequent uptick in equity markets later. The Pensions Authority and the pensions regulator in the UK have mentioned the risk of safe haven scams in respect maybe of transfer values, and in respect of other maybe asset classes, assets that, you know, some advisors out there are saying are COVID proof or recession proof, which, as we know, is not the case. The importance of member communications has been highlighted and has come up on a few occasions. So ensure that any potential delays in fund switching or in making a transfer or transfer value, or just simply purchasing an asset on behalf of the scheme is communicated to the members as delays have arisen. There is some recent UK case law, Tinconi versus James Hay Partnership, where the trustee was found to be liable in similar circumstances. ESG performance has been relatively outstanding since February, and that surprised, I think, a lot of industry stakeholders to see that ESG stocks have scored very well, and they outperformed others since the start of the pandemic. Sustainable portfolios generally perform very well. It's an indication that investors are seeking greater corporate transparency and stakeholder accountability and commitment to climate change. And of course, Nest recently divested from tobacco stocks as an indicator that, you know, SEN stocks are, stocks that are companies whose activities really affect the environment, won't be tolerated anymore in portfolios. IOPA, for its part, sees pensions as long-term investors, and they've noted in a recent report that the pension investor provides stabilization to markets. So this is somewhat similar to what the Pensions Authority and the UK Pensions Regulator has said. On directly held property for single member schemes, gearing and loan repayments has come up. We know that the moratorium on rent increases and evictions is going to expire on the 1st of August. I think that was announced yesterday. It allowed for increased notice periods for tenants as well, and notice termination couldn't be served during the emergency period. So some of that will fall away in August, and it'll be interesting to see the effect it has. I mean, property has undoubtedly, for single member schemes, been a standout asset in terms of borrowing has been available, and non-recourse borrowing has been available, and obviously you have the CGT advantages as well on sale. But some things can come up and start making it a little more difficult for property at the moment, though it's hard to know how it will play out over the coming months. Options where you run into difficulties with scheme liquidity on mortgage repayments, you might look at partial sale of another asset to allow for payment of management charge and things like that, and that will certainly be of assistance. How the property market looks later this year is difficult to know. Supply is still a significant issue, as we all know, and the property market hasn't been impacted in the way that many thought it would be. So moving on to the next slide, then looking at private company loan notes and loan agreements. Loan note defaults for small companies certainly been an issue. They're looking for moratoriums and potentially to restructure as well. In some cases, there might be senior debt there where interest payments are due, and they're looking for additional funding from mezzanine investors, including pension funds, to meet those payments. On the downside, the cost of enforcing security, if you have a well-drafted loan note instrument with the right events of default and the right borrower covenants, and you're in a position where you can enforce and you have security, that it's not an unsecured loan. You're looking at issues like investor commitment. If there's a number of investors in there, will there be conflict? Some may be happy to enforce, others might be happy to wait and to allow the company work through the period. And of course, at the moment, it's the value of the company's assets. So even if you have a debenture over company's assets, or for instance, a share charge, what worth is there in it? And is it actually worthwhile incurring the legal costs in enforcing your security? Issues to surface, structuring issues around term and security. Obviously, as I said, if the loan is unsecured, the pension investors are in a much more difficult position. And just the terms, the commercial terms of the loan, can they be potentially restructured? Can a maturity be extended for a loan note? I mean, of course they can, but that gets down to the nitty-gritty negotiation between the parties. Conflicts of interest, as I said, often between investors in these instances where they're holding loan notes. Advice and due diligence is a big one. So advice in respect of the advice, the point of sale, statements of suitability, things like that. If those are done by advisors, was a really suitable investor for that pension investor, and given their life stage as well and their age. In terms of new money, so if you're looking at new loan notes, some things to bear in mind. If you're looking at potential opportunity, an advisor or an investor, insured connectivity and arm's length requirements are met. So the arm's length requirement is a revenue rule. Connectivity occurs, of course, under Section 10 of the Taxes Consolidation Act. Just make sure those requirements are being met, and that you're happy with the level of connectivity between the parties, so between the company and the pension investor. And of course, beware the 5%, 10% rule as well for private equity. So the majority of SaaS investments, certainly in private companies, it doesn't have to be a private company, it can be a PLC as well, but typically it's a private company. Where a private company investment is happening, then the 5-10 rule applies. Due diligence for trustees is something I'm going to speak about next, and this has come up in a recent UK case, and that's just on the next slide. It's the case of Berkeley Burke SIP Administration versus the Financial Ombudsman Service Limited. The case potentially creates new due diligence requirements for SIP providers or trustees. The facts of the case are the members of the schemes were advised to invest in a very speculative green oil project in Cambodia. The trustee had conducted very little due diligence, which wouldn't be unusual, on the investment, and had not investigated whether the necessary land plots had been acquired or planted. The trustee hadn't kicked the tires, and that's something that it looks like, on the basis of this judgment, will actually be required. There will be trustee diligence potentially, from a certain reading of this judgment, would be required in every case. So it's not binding in Ireland. Obviously, it's just persuasive authority, but if it is followed, it could make life very interesting for trustees of single member pension schemes when making this type of investment. So a due diligence process, may have to be built and built into its investment procedures. Moving on to the next slide, I think that's it for me. I'm going to hand back to Stephen now for just a roundup of regulatory matters and some key takeaway points from ourselves.
Thanks, Patrick. I just want to flag where we are with some major pensions issues that are going to pan out in the next, I'd say, 2 to 3 years, really, and some sooner. If we look at IORP2, I suspect everyone on this webinar is familiar with IORP2 and has attended webinars on how the pensions world is going to change with IORP2. But we've been waiting on IORP2 for a long, long time at this juncture, partly due to the fact that the APTI took a JR in relation to the transposition of IORP2 into Irish legislation. So it needs to be transposed through legislation, and there was arguments that APTI flagged as to how this was going to be brought about. So the issue with the transposition of IORP2 is IORP1 had basically didn't concern single member pension schemes. So those schemes weren't affected by IORP1. Now the proposal is that IORP2, and the previous minister, Regina Doherty, had flagged that IORP2 would have an effect on single member pension schemes. And this would greatly affect those schemes. For instance, you'd have diversification of assets, for example, whereby a single member scheme wasn't affected by the requirement to have a diversification of investments. IORP2 will mean that they do have to. So investing in a single asset won't be it won't be permissible anymore. So how IORP2 will come in is a question. I've been told that it's going to be transposed in September or October of this year. So things will change vastly from a pensions perspective in September or October. Now, we've been told these dates before, so there may be slippage. And it'll be interesting to see how the transposing legislation deals with single member pension schemes. Will it exclude these schemes from its remit as its predecessor, IORP1, did? Interesting times ahead to see what is included in the IORP2 transposing legislation. So watch this space on IORP2. State pension age, well, this was unexpectedly a major election issue because, as we know, the plan was to increase the state pension age to 67 in 2021 and 68 in 2028. Well, a handbrake has been placed on this, so there will be no increase next year to 67. Now, the issue is, and as was flagged by the state's fiscal committee last year, that the state pension age, it is unsustainable in its current form. I think that's pretty clear. So one of three things has to change. Either the amount of pension has to reduce, the PRSI that pays for the pension has to increase, or the state pension age has to increase. So a handbrake is being placed on the state pension age. So you're looking at one of two things really happening if we assume that the state pension age won't move for the next while. You're looking at either a reduction of what is a pretty generous payment in the state pension, or an increase in PRSI to pay for what is an ever increasing, ever more expensive benefit. So once again, how will this play out? Will we see changes with the state pension age? Will we see a reduction? All are very highly unpopular from a political perspective, but something's going to have to happen there. Auto enrollment, I think COVID has definitely put a slowdown on this, because we were expecting to see this in 2022. That, I think, is pretty clear that will not happen for a vast variety of reasons. It's going to be seen as a tax on employers, an unwanted expense on employees, and also it's going to take a lot of infrastructure to get this up and running. You're going to have a lot of interaction between the entity that's set up to run it with the NTMA, and it's going to be expensive to set up, and I don't think the state has the appetite for it at the moment. But that said, it has been flagged, and a commitment has been made in the programme for government, but no timeline's been made. I'd suggest that you're looking at 2025 at best. I think a 3-year slippage due to the pandemic would not be out of the ordinary. And then you're relying on no second wave or nothing happening before 2025, because this has been derailed several times. So once again, auto enrollment, watch this space. So the key takeaways, and not to labour the point, auto enrollment still on the cards, but unlikely to be 2022. IORP2 will vastly change the pensions landscape in Ireland. We're told transposing legislation that will explain the nature of these changes will be in place in September or October. State pension age, expect this to be a very sensitive topic for a time, but also look at changes in relation to possible PRSI or reducing the benefit. Unregulated investments, once again, keep an eye on the interaction between this area and IORP2 and the transposing legislation. Regulated investments, keep an eye out for Pensions Authority guidance in this area. And now I'm delighted to hand over to Eugene for what hopes to be a very interesting segment of the presentation today.
Thank you very much, Stephen, and welcome, ladies and gentlemen. Glad that you could join the webinar this morning. I'm going to focus on a few points for people approaching retirement in the presentation. I'll remind you of the generous tax reliefs available for corporate pension plans both before and after retirement. I will have a look at just how benefits are paid to people currently, how they're drawing pensions out from their fund, and maybe just some of the tax consequences of that at a very high level. I'm going to look at a thing that creates quite a sting in the tail. So it's a very important area of pension planning for people with larger funds. And finally, I'll identify a few areas where we're getting client interaction, where people are asking us questions as they approach retirement. So as you can see on the first slide here, I've summarized the very generous reliefs available from the revenue under 3 headings: under funding in the first instance as the fund builds up, within the fund on an ongoing basis, and then at retirement to see how just to show how benefits come from the fund. So as you can see, as contributions are contributed to the fund, you can take a chunk of money from your company, transfer it across into a pension fund in your own name, and on that transfer there is no USC, no tax, no PRSI. The company gets corporation tax relief on that, and the amount of funding that's available, the revenue do have very generous limits in the corporate pension space. There's no earnings cap, for example. There is a 115,000 earning cap for the self-employed for personal pensions. Then within the fund, there is no taxation, so no Irish taxation. So for example, if you buy an asset, it improves in value, you sell it subsequently, there's no capital gains tax paid in Ireland. And then finally, as you come to retirement age and you're drawing money from the fund, you can take 200,000 tax-free up to that amount, subject to that being a quarter of the value of your fund. Then a next tranche of 300,000 is paid at a reduced tax rate of 20%, again subject to that 25% of fund value limit. Then the residual amount, the 75%, is then transferred to a post-retirement vehicle called an approved retirement fund. And again, within that vehicle, it can grow free from Irish taxes. So if you move on to the next slide here. And this slide what I'm looking at here is basically how people utilize the income from their fund at retirement. And I'm just going to focus just to highlight a couple of tax points here on the last two rows. I'm going to focus on someone who has a fund at retirement of 1.2 million. And as you can see, they can get a fund net of a small amount of tax of 200, they get tax-free payment of 280,000. Then the residual amount, as I said before, goes across into an approved retirement fund. And if they drew 4% of that amount out, that would be an amount of 36,000. And that's the tax-free income for a married couple over age 65 in retirement. So quite a generous amount can come out from the fund tax-free. I've focused on the next column down, the 2150 number, because I'll talk about that in a bit more detail later on. It really is the high point for pension planning. You don't want to go beyond that. If you have a fund of that size, 440,000 comes out tax-free, and then the 4% drawdown equates to 64,500. The next slide just identifies the tax efficiency for people in retirement. There's a series of reliefs for married people and those in civil partnerships over age 65. There's an exemption and some marginal reliefs. So as you can see, as I said before, someone getting 36,000 of income has a zero tax rate. If, for example, a year or so later they received a state pension and it brought them up to 50,000, that would have an effective tax rate of 11.2%. Now, these are all very high level. Everybody's tax situation is different, but I just wanted to draw your attention to tax efficiencies both before and after retirement. However, as I said before, there is a bit of a sting in the tail, and the next slide just draws your attention to that. The Revenue a number of years ago introduced a very penal tax, a chargeable excess tax on all fund values over 2 million. So there's a charge of 40% on the excess amount over 2 million. And as it is an excess tax, I'll identify just how it works out in practice in a few moments. But I just want to draw your attention to one other tax relief, which is that you can offset the any CET against the lump sum tax I referred to in the previous slide. So in practice, what that means is that the effective most beneficial pension fund size is 2.15 million. That's the most efficient. Above it gets very penal, and as I move on to the next slide, you'll see just how that works in practice. So this shows the combined effect of that excess tax I referred to and just the normal taxation in an ARF. So if someone had €100 over the cap, they would pay CET on that of 40%, 40 quid. And then as money is drawn out from the ARF, and I've taken the highest possible level of tax here, the marginal rate 52%, they pay another €31. So you can see the effective tax rate for someone who has a fund over the cap is 71.2%. So it's a very, very penal tax. Therefore, it's worthwhile for people, one, to look at it, to avoid it, and obviously to look at planning tools if you do get close to that point. So as I move on to the next slide, I'll identify some of them. The one we would see people use most regularly is ceasing contributions. So as you approach retirement age, if you feel you're getting close to the cap and you want to make some allowance for investment growth, well, then you cease contributions. The next thing you can do is crystallize benefits early. So take early retirement, and that, if that's options available to you, and transfer the balance to an ARF. Because the future growth in an ARF is both tax-free, as I've mentioned before, but it's also free from the cap on the CET cap. So that's a method people do use to ensure they don't pay excessive taxation. The other areas that people will then explore is, for example, if it's a family business, a spouse may be employed in the business, and you can then pension the spouse, and they have a cap of 2 million as well, assuming you need to look at the particular circumstances of the spouse's employment. And finally, I'll just draw your attention on this slide to one situation for anybody who might be a consultant in the HSC or know any of them. You can draw their attention to it. There is an ability for HSE consultants to get a retrospective personal fund threshold, which is higher than the €2 million I referred to earlier. So that only applies to consultants. So we would be doing a fair bit of work in that area now. So just want to draw people's attention to it. As we move on, my final slide is basically drawing your attention to some things we're coming across quite regularly from clients and client interaction. The first one, and it's quite a significant area, is defined benefit schemes. People in defined benefit schemes don't have the option of getting a quarter tax-free and an ARF. They may quite often get a lower tax-free lump sum, particularly for those with bigger pools of assets. So they get a lower tax-free lump sum and they're forced to buy an annuity. And that isn't attractive given low annuity rates and just the inherent features of annuity rates for a lot of people. So we would see those people trying to exit the defined benefit scheme via a personal retirement bond close to retirement age. But it's a very complex issue and needs to be examined in detail before acting on it. The other thing, area we see a lot of need for planning as you approach retirement is the various pension structures that people will have. Most people have worked for maybe more than one employer. They will have, maybe have had periods of personal employment, may have PRSAs, may have personal pension plans. So you need to bring those structures together to think about how you're going to play benefits out from them, particularly for those people closer to the cap, because if you use a phased retirement structure, it can defer the payment of CET into the future. The other area I would draw attention to is just various legal issues around retirement. As you approach retirement age, like for example, an ARF can be transferred, in the event of death in retirement, to a spouse tax-free, but your will should reflect the fact that the ARF is going to go across to your spouse, or else it could create some legal issues. Other things we can see is just planning for your people's ability to manage their ARF in retirement, that they have appropriate living wills and have given consideration to how they will manage the ARF through as they age. And I think it's important to give consideration to that as you approach retirement. The last item I'll draw your attention to is just, it's an area we do see people having an issue with on death in service, and would only apply for people who have both large pension funds and insured death in service benefits through their employer. And what those individuals can find is that their pension fund, in some very limited circumstances, are so large that they could go back across to they wouldn't be able to be paid out in the event of death and will go back to the old employer. Or more commonly, what we see is that their pension fund is used to provide an annuity, and many people don't like that and they look for alternatives to it. Now, there are planning opportunities around that. So for people with large pension funds who do have death in service benefits, I would encourage you just to give a bit of consideration to that, as you approach retirement age. I'm going to hand back over to Stephen now to organise the Q&A, and I'd like to thank you for your time.
Thanks, Eugene. As Ronan mentioned, there's a Q&A function on the Zoom, so feel free to pose any questions to the panel. I see we have a number. Ronan, unfortunately, no bids for your piece of art yet, but we've still got a few minutes left, so feel free. He'll consider any reasonable offer. Okay, I'll take the first question. We actually have two on this. It's in relation to, just because an employer was availing of the TWSS, does that really mean that their employer contribution liability for the employees on the TWSS would decrease? Yes, essentially, because if a TWSS is paid, the employer the salary is going to be less. So the employer contribution, usually under the trustee letter of exchange, is expressed as a percentage of salary. So a reduction in salary together with the revenue requirement, or the revenue, it's in the guidance notes, that the reduction can't come from the TWSS payment, means that the employer contribution will go down to the pension scheme. That can be tempered. Obviously, the employee can decide to make an employee contribution to maintain it through an AVC perhaps. So there are options around that to keep the payments up at the required level. Okay, let's have a look. Eugene, one for you. How prepared do you think most people are for retirement?
Stephen, I think the answer is that it's a very mixed bag. I think it falls into two categories. It's basically those who have taken advice and who consider it and who've planned for it. And we find, those individuals to be quite well planned and have given it a lot of thought. There would be a second category of individuals, and it's probably more common, where it's traditionally been the employer who's arranged for their affairs to be managed. They've set up the pension scheme. They've given attention to it all the way along, and those individuals probably have given less thought to it, but tend to focus on it probably closer to retirement age. And it would be a little bit better if it was done earlier, because there tends to be a little bit more optionality about it.
Okay, thanks, Eugene. Patrick, one for you here. How does the 5-10% rule work?
Yeah, so the 5-10% rule, firstly, I guess it relates only to SSASs, so small self-administered schemes. Some providers will apply a similar investment policy rule to ARFs, for instance, or even PRSAs as well. But it actually, the rule only applies, the revenue rule itself only applies to SSASs. It requires that the maximum private equity, so that's shares in a private company that a pension can invest in, is to a maximum of 5% of scheme assets or 10% of the company's share capital. In terms of how that plays out, it means that the majority of pension or single member pension investments in private companies occur then by way of loan note or loan agreement, loan instrument or loan agreement. So an investment by way of debt. You see convertible loan notes as well, and you might even see an equity kicker that would be of a nominal value, so it wouldn't fall into the 5-10 consideration, but that's how the rule works.
Okay, cheers. Okay, I'll address this. In terms of AE and the likely delay of same, how likely do you think it might be that the government might look for an oven-ready solution, such as AE-specific variation group PRSAs, and what would be the challenges of this approach as you see it? I'm not sure whether it's back to the drawing board in terms of AE and what we're going to see, or whether we're looking at a new departure. There's been several announcements about the likely infrastructure of AE, and I am surprised that the existing structure for PRSAs hasn't been examined in more detail to see what tweaks could be made to make it more ready for AE, and possibly as a means of reducing the infrastructural setup of the AE system going forward. This is something that the government may look at in more detail, because certainly there will be a focus on reducing costs in the setup, be it infrastructure or the state funding for same. So it may be something that's looked at. I don't know. I don't have any inside knowledge, but I think with the focus being on to reduce the costs of the AE system, probably that's something that could be considered. Eugene, one for you, I think here. How does funding for a spouse work?
Okay, yeah. What happens in that scenario is, first, the spouse does have to be employed in the business. So usually it works best for family businesses. And if the spouse is employed and is in receipt of income, they're then able to fund that income to provide a pension scheme, to provide a pension based on the income, exactly as it was, say, for the directors of the company, or anybody working for say as an executive of a company. So the funding limits are exactly the same. The amount of benefit you can put in, the amount of contributions you can put in, the same, and the overall cap ceiling is the same. The most important thing is that they're actually working in the business and actively engaged in the work and providing relevant service, so that it is a tax deductible salary in the first instance.
Okay, thanks, Eugene. Another one for you actually here. Does Eugene think that single member SSASs should not be counted or supervised by the Pensions Authority? Should the Pensions Authority supervise just group schemes?
I suppose single member schemes at the moment would have supervision coming from Revenue, Pensions Authority, and indirectly through the central bank. So you've got three regulators layering on increased levels of regulation at each stage. So it is making it much more difficult to structure and run those kind of arrangements. And they have proven to be very attractive arrangements for people. The growth in the single member SaaS market has been quite significant over the last number of years. So they are very attractive vehicles. I think the best solution would be, a simplification of it so that the single member schemes were exempted from the IORP2 directives, as was done with IORP1, I might add, and has worked very well, and the market has grown quite well. So I think that would probably be the best outcome, given what you're saying about the Pensions Authority issuing guidance on IORPS2 later in the year.
Yeah, thanks, Eugene. And that kind of ties into a question. Have you heard, I can deal with this one probably, have you heard any feedback on the likelihood of IORP2 being introduced with an exemption for single member schemes? Well, pre-COVID and probably pre the APTI case, it looked like IORP2 was going to come in blanket effect, so it would concern SaaSes as well. Going forward, I certainly haven't heard anything, but one would imagine that greater consideration has been given to it, bearing in mind the APTI case and what happened during that case, which I won't go into because it would take too long. So I would say there's more of a possibility of an exemption being applied than there was pre-COVID and pre-APTI case. But it's a case of wait and see. The transposing legislation is, we've been promised, just around the corner. So once that comes out, we'll know for sure. Another one on the TWSS that I'll answer quickly. If my obligation as an employer pre-COVID was to pay 5% of basic salary as a contribution, just because I'm availing of the TWSS, does my obligation reduce? Well, it essentially comes down to the definition of basic salary. So if you are paying Stephen Gillick a basic salary of 100,000 pre-COVID, and this has come down to 80,000, then you're paying a contribution of the 80,000 because the basic salary is being reduced. And we have been informed by the Revenue that you cannot make a reduction from the TWSS top-up payment. So in short, the answer is probably yes, but you have to look at the scheme documentation and the various definitions. Patrick, one for you here, I think, and we're getting to the end of the questions. Do you know if any pension lenders have been offering payment moratoriums to borrowing schemes?
No is the short answer. To my knowledge, it hasn't occurred yet. Some scheme members, we were told by a client of ours, had been looking for it potentially in respect of non-recourse lending that they had on a property asset. I guess looking at what was happening for on the private mortgage side. But no is the answer. As far as I know, the lenders aren't currently offering moratoriums. How that will play out going forward as the rent moratoriums, the eviction issues all drop off in August, and the TWSS and the wage subsidy, or sorry, the COVID unemployment payment drops off, then perhaps we will see deals being done. But to my knowledge, it's not being offered presently. Okay.
Cheers, Patrick. One final question. Eugene, I'll pose this one to you if I may. How much can my company put in if I am earning 100K and the company have profits in the company?
Well, again, it's a very variable response. I suppose the best way I can give you is a kind of a rule of thumb I would use, which is for someone who's 50 years of age, say with no pension assets going through to retirement at age 60. You can basically, the fund you should build, you can optimally target as 2.15 million. So that means you could put in that amount over the 10 years. That could go in at 215 grand a year, or it could go in with say a larger upfront payment, depending if you've passed service or something like that. So we would see situations where someone might put in 500,000 and then fund the rest with lesser amounts over the balance of over the number of years. But the company can put in up to the cap in essence once you've 10 years service and by retirement age and 100 grand of salary.
Okay, thanks, Eugene. And that's all the time we have for Q&A. And with that, I'd like to thank Ronan and Eugene from Harvest and my colleague Patrick from MHC. Contact details are up on the slide deck there if you'd like to get in touch with any of us in relation to any query that you may have. And I'd just like to thank you for your attendance this morning and hope that you found the webinar to be informative, and hope you have a great remainder of the day. Thank you.